Imagine for a second that your biggest competitor launches an identical product to yours, but for, a fraction of the cost.
Right, and the whole industry is just screaming that you're about to get crushed.
Exactly. I mean, every analyst on Wall Street, the financial media, they're all collectively telling you that if you don't slash your own prices in response, you're done.
But instead of panicking, you do absolutely nothing.
Yeah, you do nothing. You hold the line on your pricing. You completely refuse to engage in a price war. And somehow you don't just survive the onslaught, you actually capture record-breaking market share.
And expand your profit margins, right?
Right. You pull in billions of dollars in new capital. It's wild.
It completely defies the standard economic gravity of the asset management industry. I mean, for the last 2 decades, the passive investment space has really just been characterized by this brutal, unrelenting race to zero.
The lowest fee wins?
Exactly. We've been conditioned to believe that the lowest expense ratio automatically wins the capital. That investors are these, perfectly rational actors who will abandon a legacy product the second a cheaper clone hits the market.
Which brings us to our mission today. Welcome to a special Talk Tickers edition of the Deep Dive. We are slicing straight through the corporate jargon of Invesco's Q2 2026 earnings call, that's ticker symbol IVZ, for you following along.
And there's a lot of noise out there right now.
Oh, heavily distorted by macroeconomic noise. But buried in this specific earnings report is an absolute masterclass in strategic positioning. Today, we're going to look at how a firm managing trillions of dollars is fundamentally rewiring its balance sheet.
Calling the bluff of its cheapest competitors, really.
Yeah, calling their bluff and capturing a massive secular shift in how human beings deploy their capital. All the data translated for your portfolio, zero fluff.
The underlying narrative here, is really about the mechanics of scale. We are looking at a company that has reached a critical mass where its products are no longer just investment vehicles.
There's something else entirely now.
Right. They have become structural financial infrastructure. And when you transition from being a product provider to an infrastructure provider, the normal rules of pricing and competition, they simply stop applying.
Well, let's get straight into the headline data drop, because the scale you are talking about is frankly staggering. Let's look at the numbers.
Let's do it.
So Invesco just reported their total assets under management, their AUM, hit a record high of $2.5 trillion.
Trillion. With a T.
With a T. That is a 14% increase sequentially from Q1 and a massive 23% jump year over year.
Which is, a $2.5 trillion asset base requires an entirely different operational mindset than managing, say, 50 billion or even 500 billion.
How so? Like mechanically?
Well, yeah, at that scale, you are essentially functioning as a macroeconomic entity. The sheer gravitational pull of that capital means that even minor adjustments in your operational efficiency, they translate to massive absolute dollar figures on the bottom line.
Right, and we see that gravitational pull directly in the revenue and profitability metrics they just dropped. Okay, let's unpack this. Net revenue for the second quarter came in at $1.3 billion.
Which is up $224 million year over year.
Yeah, an impressive jump. And adjusted diluted EPS, the earnings per share, it nearly doubled. It jumped from 36 cents last year to 71 cents this quarter. But the metric that absolutely leaps off the page for me is the operating margin.
Oh, the margin expansion was incredible.
It expanded by 630 basis points to land at 37.5%.
And for anyone listening, operating margins in the high 30s are just elite for a diversified global asset manager. We really have to look at the mechanics of operating leverage to understand how they even achieved a 630 basis point expansion.
Meaning they kept 6.3% more profit on every dollar coming through the door.
Exactly. Asset management is an inherently scalable business, right?
Yeah.
But only if management enforces strict discipline on the expense side. When a firm adds new assets, the marginal cost of managing that next dollar should ideally approach zero.
Because the systems are already built, right? The portfolio managers are already salaried, the trading algorithms are already up and running.
That's the theory. But the reality is that many firms use periods of high revenue growth to just bloat their expense base. They hire aggressively, they expand into these vanity projects, and they let administrative costs creep up.
Lifestyle creep, but for a corporation.
Exactly. But what Invesco demonstrated this quarter is just ruthless cost containment in the face of massive top-line growth. They captured the revenue increase without expanding the denominator of their cost base. And that forces that 630 basis point expansion directly into the operating margin.
Okay, I have to challenge the narrative of pure strategic brilliance here, though. I mean, are these numbers actually impressive, or did Invesco just get a free ride?
A free ride from the market.
Yeah, we are looking at this $2.5 trillion AUM figure in the context of mid-2026. The broader equities market has been on an absolute tear. If the S&P 500 and then NASDAQ are printing new highs every week, Invesco's AUM naturally inflates.
Right,
it does.
It absolutely does.
They collect their fee on a larger asset base without having to lift a finger. And management themselves cited on the call that $257 billion of this AUM increase was purely driven by market appreciation.
You're hitting on the perpetual beta problem in evaluating financial institutions.
Right.
It's the question of, are they a generator actively creating their own power, or are they just a solar panel passively soaking up whatever sunlight the market provides?
I love that analogy.
Because if an asset manager's growth is entirely beta-driven, entirely reliant on the market going up, they are fundamentally vulnerable.
Because the moment the music stops,
the moment the market cycle turns, that AUM evaporates, the fee revenue plummets, and the stock price collapses. It's a house of cards.
So we have to isolate the alpha in their business model. We have to find where the money is actually in motion. Did they actually bring in new clients?
And we find it in the flow data. This is where the story gets really strong. Invesco pulled in a record $45.1 billion in net long-term inflows during the second quarter. Yes. That translates to a nearly 9% annualized organic growth rate. So to your point, this isn't market appreciation. This is $45.1 billion of fresh net new capital that clients actively diverted from bank accounts, from cash equivalents, or from competitors, and specifically handed to Invesco to manage.
Okay, that distinction is everything for the listener evaluating the stock. They didn't just ride the wave, they actively captured new money.
And it's crucial to point out this wasn't a one-off quarter driven by, a single massive institutional mandate that just happened to land in Q2.
It's a trend.
A massive one. This marks their 12th consecutive quarter of net inflows.
Wait, really? 12 quarters? That takes us back 3 full years.
Exactly. 3 years. Think about what happened over the last 3 years. They have maintained positive organic growth through the tail end of the inflation spikes.
Oh, right.
Through the most aggressive Fed hiking cycle in modern history, and through massive geopolitical volatility.
Generating 12 consecutive quarters of net inflows in that specific macroeconomic environment, that's a statistical anomaly for a legacy asset manager.
It really is. It indicates a product suite that is highly adaptable to changing client demands. When equities were selling off hard, they clearly had the fixed income or the alternative products ready to catch the capital that was fleeing the stock market.
So the money didn't leave the Invesco ecosystem, it just shifted rooms.
Precisely. And when tech rallied, they had the vehicles to capture that upside. They have essentially built an all-weather capital capture machine.
Well, capturing $45 billion in new money is no accident. Let's dismantle that machine and look at the actual engine driving this. Where exactly is that money flowing? We have to talk about the undisputed heavyweight in their portfolio, the QQQ.
The juggernaut.
Anyone who has ever traded a tech stock knows the Qs. It tracks the NASDAQ 100. But the earnings call revealed a structural accounting shift that I found fascinating.
The fee conversion.
Yeah. The conversion of the QQQ2 fee earnings generated an incremental $130 million in net revenues in just the first half of 2026. What exactly happened there?
To understand the magnitude of that $130 million incremental bump, we have to look at the history of how the QQQ was originally structured. You see, the QQQ isn't just a standard modern ETF. It is one of the oldest exchange-traded products in existence.
Right, it's been around forever.
Because of when and how it was created, it operated under this legacy legal structure historically related to unit investment trusts and these very specific licensing agreements. And that old structure dictated how the sponsor, which is Invesco, could extract revenue from the fund's operations.
So they were essentially operating the most popular tech fund in the world under an outdated, suboptimal monetization contract.
Exactly. They were leaving money on the table. So by modernizing the structure and converting it to standard fee earnings, they finally unlocked the true run rate profitability of their flagship asset.
And the timing couldn't be better.
Couldn't be better, considering the fund's AUM grew 20% in just the first half of the year. They are finally capturing the full economic value of the immense liquidity they provide to the market.
Okay, so the QQQ is the anchor, obviously, but the broader ETF complex is pulling massive weight as well. They reported a record $30 billion in net inflows across the ETF and index segment just this quarter alone.
Yeah, the total ETF complex AUM now sits at roughly $1.25 trillion.
Unbelievable. And it's not all just passive market cap weighted funds either, is it?
Not at all. The composition of those flows tells a very compelling story about the evolution of the modern investor. Management noted that their quality and momentum equity factor funds raised a record $7 billion.
Factor funds.
And they also highlighted $25 billion managed across more than 40 actively managed ETF products. This represents a huge structural evolution in the industry.
Because the active ETF space has been the holy grail for a while now, hasn't it? The traditional mutual fund is kind of dying a slow death because of its tax inefficiency and high fees.
It really is. Investors want the alpha generation of active management, but they want it wrapped in the tax-advantaged, highly tradable structure of an ETF.
And Invesco is just aggressively positioning themselves to capture that migration.
They are. Institutional allocators are increasingly moving away from vanilla market cap weighting and deploying their capital into factor-based strategies.
Yeah.
Momentum, quality, low volatility.
So capturing $7 billion into those specific factor funds, that indicates Invesco's quantitative research and product development teams are successfully anticipating where institutional capital wants to go. They aren't just offering a generic S&P 500 clone.
They're ahead of the puck.
I want to go back to the QQQ for a moment, though, because earlier you used the word infrastructure.
Yeah.
When I look at the QQQ of just its sheer size, its ubiquity on every single trading desk in the world, it strikes me as the financial equivalent of a massive tech operating system, like iOS or Windows.
That's a great analogy.
Right, because developers build apps for iOS because that's where all the users are. And users buy iPhones because that's where the apps are. It's a closed loop. Everyone is locked into the ecosystem. Is that what's happening with the QQQ?
That network effect analogy is perfectly mapped to market microstructure.
Yeah.
Yes. An ETF reaches a certain threshold of liquidity where it ceases to be merely a directional bet on a basket of stocks. It transforms into a utility that other market participants actually use to operate their own businesses.
I imagine that has to do heavily with the derivatives market, right? If I'm a hedge fund manager, I'm not necessarily just buying and holding the QQQ for the long haul. I'm trading the options chain. I'm using it to hedge out systemic tech risk so I can isolate my alpha on a specific stock pick.
CEO Andrew Schlossberg made this exact point on the call. He pointed out that the QQQ is the fifth largest ETF globally by assets, but it is the second most actively traded.
The volume is insane.
The on-screen liquidity means that institutional block trades of hundreds of millions of dollars can be absorbed instantly without moving the underlying price. But you're right. The options market is the true moat here. There is $500 billion, $500 billion of notional options associated with the QQQ.
Let's break down the mechanics of why that options chain makes the QQQ so untouchable. Because if a competitor launches an identical NASDAQ 100 ETF, but they charge a zero management fee, why doesn't the hedge fund just switch to the free version?
Because the management fee is largely irrelevant to an institutional trader compared to the execution costs and the hedging capabilities.
Okay, walk me through that.
If market makers are actively selling options on the QQQ to hedge funds, those market makers must hold the underlying QQQ shares to remain delta neutral. They have to manage their own risk.
Right, they have to buy the stock to offset the options they sold.
Exactly. This creates a massive, continuous, non-price sensitive demand for the physical ETF shares.
So they are forced to buy the QQQ to hedge their own books, which creates tighter bid-ask spreads, which makes the QQQ even cheaper to trade, which attracts even more volume.
It is a self-reinforcing liquidity flywheel. The competitor's zero-fee ETF won't have a developed options chain. Therefore, the market makers can't hedge effectively. Therefore, the bid-ask spreads on the competitor's ETF will be wider.
So if a hedge fund tries to move $1 billion into the cheaper competitor,
the slippage they suffer on that wider bid-ask spread will instantly vaporize decades worth of savings from the 0% management fee.
Wow. That completely locks out the competition on the institutional side. The math just doesn't work for them to switch. But what about the retail side? We know switching costs for retail are different.
They are different, but they are equally restrictive because of the tax code.
Capital gains.
Yes. If you are a retail investor who bought the QQQQ 5, 10, or 20 years ago, your cost basis is incredibly low. If you decide to sell your QQQ simply to move your capital into a competitor's fund that charges a few basis points less, you trigger a massive capital gains tax realization event.
You would have to hand a massive percentage of your wealth to the IRS just for the privilege of saving a microscopic fraction of a percent on future management fees.
Exactly. The tax friction creates a multi-decade lock-in. It is a brilliant, entirely legal monopoly on a specific segment of capital.
And that infrastructure level stickiness is what allows management to be so confident in their pricing strategy, which we will definitely analyze when we look at their future guidance.
It's the key to their whole defensive posture.
But before we get to the guidance, we have to look at the other major growth engine discussed on the call. And this caters to a completely different demographic than those high-frequency institutional traders.
You're talking about the SMAs.
That's separately managed accounts. A massive retail shift. Their U.S. wealth management SMA platform grew to $40 billion, and it clocked a staggering 23% annualized organic growth rate.
The explosion of the SMA business is perhaps the most significant structural shift in retail wealth management over the last decade.
Explain why it's growing so fast.
Historically, if you had $1 million to invest, your financial advisor put you in a mutual fund. You owned a fractional share of a massive pool of assets. But the problem with the mutual fund structure is that you inherit the tax liabilities of the entire pool.
Right. So if the portfolio manager decides to liquidate a massive position in Apple for a huge gain, and you just bought into the mutual fund yesterday,
you still get hit with a pro rata share of that capital gains tax distribution at the end of the year.
Even though you personally experienced none of the upside.
Exactly. It is a fundamentally flawed structure for taxable accounts. An SMA fixes this by giving the investor direct ownership of the underlying securities in a separate dedicated account, while still allowing the asset manager to direct the overall strategy.
The primary driver here is tax loss harvesting, right?
Absolutely.
With direct ownership, the software can scan your specific portfolio every single day. If one specific stock dips, the algorithm sells it to harvest the tax loss, instantly replaces it with a highly correlated substitute to maintain the asset allocation, and banks that loss to offset your gains elsewhere.
It's incredibly efficient. And direct indexing and automated tax loss harvesting used to be services reserved exclusively for ultra-high net worth individuals, the centimillionaires.
Because it required an army of accountants.
Right. Massive manual oversight.
Yeah.
What has changed and what Invesco is capitalizing on so well is the technological scalability of these algorithms. They can now offer mass-customized SMAs to the mass affluent, say, someone with $200,000 to invest with the exact same tax harvesting sophistication.
And it is clearly working. 23% organic growth is phenomenal. Now, the call specifically noted that a significant portion of this SMA growth is flowing into fixed income strategies, particularly municipal bonds and short duration strategies.
Which makes perfect sense given the macroeconomic context of 2026.
Right.
With interest rates providing actual meaningful yield, investors are highly focused on the tax efficiency of that yield. Municipal bonds are uniquely suited for SMAs because the municipal bond market is highly fragmented, it's relatively illiquid, and it's deeply tied to the investor's specific state of residence for tax exemption purposes.
You can't just buy a generic national mutual fund if you want to optimize for your specific state income tax bracket.
Exactly. And SMA allows Invesco to build a bespoke municipal bond portfolio tailored precisely to the tax geography and yield requirements of the individual client.
So capturing this flow proves that Invesco has successfully diversified beyond its reputation as just a tech-heavy equity shop.
They have deep institutional-grade fixed income capabilities, and they are deploying them very effectively to the retail market through this SMA wrapper.
Okay, this brings us to a critical inflection point in the analysis. We have this massive top-line growth. The ETFs are pulling in billions. The SMA platform is surging at 23%. But as we know, top-line revenue is vanity. Free cash flow is sanity.
Always.
How is management allocating this massive influx of cash? What are they doing with it?
The capital allocation strategy outlined by CFO Allison Dukes is what truly elevates this earnings report from a good quarter to a definitive long-term investment thesis. They are executing a textbook deleveraging cycle.
Financial discipline.
Yes. They paid down over $450 million in net debt during the second quarter alone.
Wow. Paying off nearly $500 million in debt in 90 days is a massive statement of intent. They are primarily paying down their revolving credit facility using operating cash flow. Let's talk about the mechanics of the revolver and why paying it down is so crucial right now.
A revolving credit facility is essentially a massive corporate credit card, and it's typically floating rate debt. In an environment where interest rates remain elevated or volatile, carrying a large balance on a floating rate revolver is actively destroying shareholder value through high interest expense.
Because the rates keep moving against you.
Exactly. By taking their operating cash flow and aggressively paying down the revolver, Invesco is securing a guaranteed, risk-free rate of return that's equivalent to the interest rate they were paying on that debt.
And it fundamentally alters the risk profile of the entire firm, doesn't it? Their leverage ratio inclusive of preferred stock has dropped from 2.7x down to 1.9x over the trailing 12 months.
Which is huge. Operating an asset manager at 2.7x leverage introduces a dangerous level of fragility. Asset management revenues are inherently cyclical. They are tied to market beta, what we talked about. If you have high fixed debt servicing costs and your revenue suddenly drops 20% because of a bear market, your equity value gets absolutely crushed. You can't cover the interest. Bringing that leverage down below 2.0x builds a massive structural shock absorber.
They are aggressively shrinking their risk footprint while simultaneously expanding their market share. They're getting bigger and leaner at the same time.
And that debt paydown is entirely funded by the operational leverage we discussed earlier. Look at the sequential quarter data comparing Q2 to Q1. Net revenue grew by 5%, but their adjusted operating expenses were functionally flat.
Let me make sure I have this right. They only spent an additional $2 million to generate an additional $65 million in revenue.
Yes, that is the mechanical definition of scalability. The infrastructure is built. The next $1 billion in AUM costs them practically nothing to manage. Every incremental dollar of revenue flows almost entirely unencumbered straight to the bottom line, which they then sweep directly into the debt paydown.
The question for anyone holding the stock, though, is how durable is this efficiency? Are they just starving the business of necessary investment to juice the margins for a few quarters, or is this sustainable?
That is exactly what the analysts wanted to know.
This naturally brings us to the management guidance section of the earnings call. What did they say about the road ahead?
The analysts on the call were highly focused on that exact question. The jump to a 37.5% operating margin was clearly way ahead of consensus models.
They blew it out of the water.
Right. CFO Allison Dukes was pressed on whether this was a temporary spike or a new structural baseline, and her response was emphatic. The objective is to consistently deliver operating margins in the high 30s and, crucially, to build a more durable margin profile that can withstand any market cycle.
But building a durable margin in a cyclical business means you need intense granular control over your expense base. You need the ability to dial down costs instantly if the market turns.
Which requires modern technological infrastructure.
Right, which explains the tech spend they highlighted, $15 million per quarter.
This is a vital piece of the guidance. They are in the middle of implementing a massive new hybrid investment platform. The implementation costs ran $14 million in Q2, and they are projecting $15 million per quarter through the second half of 2026.
Let's discuss what a tech migration of this magnitude actually looks like for a legacy financial institution, because it is never as simple as just installing new software and calling it a day.
Oh, not at all. It is an incredibly complex, high-risk operational maneuver. You have decades of siloed data, legacy trading systems, compliance algorithms, and client reporting interfaces that all have to be integrated perfectly.
You can't just flip a switch.
No. During the implementation phase, you are effectively running two parallel organizations. You have to maintain the legacy systems while simultaneously building, testing, and migrating data to the new systems. This creates a temporary bubble of duplicative expenses.
Which is the $15 million per quarter. But the guidance is that this implementation phase will conclude by the end of the year, and those costs will aggressively taper off by Q1 of 2027, clearing the way for more savings.
And the strategic payoff of this hybrid platform is the unification of their data architecture. Once they are fully migrated, the automation capabilities increase exponentially. They will be able to scale the SMA business even faster. They will require fewer manual back-office reconciliations.
That's headcount.
Exactly. And they will have the real-time expense flexibility required to defend that high 30s margin, even if global equities enter a protracted bear market.
So they are absorbing short-term implementation pain to secure long-term structural dominance.
That's the one.
But I want to pivot to what was, without a doubt, the most high-stakes strategic moment of the entire earnings call.
The Q&A session.
Yes, the analyst Q&A regarding the passive ETF fee war.
Oh, this was fascinating. Patrick from Autonomous Research initiated the line of questioning. He essentially cornered management on the pricing dynamics of the NASDAQ 100 ETF space.
We established earlier that the ETF industry is notoriously cutthroat. Competitors have been announcing these aggressively priced, rock-bottom NASDAQ tracking funds. So the analyst gets on the line and asks the existential question. Your competitors are undercutting you. Are you going to slash the management fee on the flagship QQQQ to protect your market share? Or are you going to hold your pricing and risk a mass exodus of capital?
It was a very pointed question. And management's response was a masterclass in strategic restraint.
They just said no.
They gave a definitive no.
Allison Dukes stated explicitly that they will not have a short-term competitive reaction. They are completely refusing to engage in a short-term race to the bottom.
I mean, it takes nerves of steel to tell Wall Street analysts that you are going to ignore cheaper competitors.
Yeah.
But they can do it because of that infrastructure moat we discussed earlier.
Exactly. Andrew Schlossberg elaborated on the total cost of ownership equation. He explicitly pointed out that sophisticated shareholders do not just look at the expense ratio.
The sticker price isn't the real price. Right. If a competitor charges 2 basis points less in management fees, but their lack of liquidity results in a bid-ask spread that is 3 basis points wider, the investor suffers a net loss on the execution.
You are literally stepping over dollars to pick up pennies.
Invesco is banking on the assumption that the institutional market is smart enough to calculate the total cost of ownership. The unmatched liquidity, the deep options chain, and the 25 years of flawless tracking history provide a value proposition that a zero-fee clone simply cannot replicate.
And they had the perfect empirical evidence to back up their refusal to panic, didn't they? The QQQM.
Yes. The QQQM strategy is one of the most brilliant examples of market segmentation in modern financial history.
Walk us through that because it's a great story.
Years ago, recognizing that fee pressure was inevitable, Invesco launched their own cheaper mini version of the QQQ, designated QQQM.
Right.
It tracks the exact same index, but it's priced lower, and it is specifically designed for buy and hold retail investors who do not require the massive daily liquidity or the options market of the main fund.
Now, this is the ultimate test of the cannibalization theory. If investors only care about fees, the launch of the QQQM should have instantly drained all the assets out of the flagship QQQ.
Every rational actor would simply sell the expensive fund and buy the cheap fund managed by the exact same company.
But that is not what happened at all.
Not even close. The QQQM was a resounding success. It gathered $100 billion in assets, establishing itself as a behemoth in its own right. However, it did not slow down the flagship QQQ's growth whatsoever.
It didn't touch it.
The QQQ continued to pull in tens of billions of dollars alongside it.
It proved definitively that there are two distinct markets.
There is the institutional trader, the algorithmic market maker, and the hedge fund manager who trades millions of dollars a second. They demand the QQQ, and they are entirely price insensitive to a few basis points of management fee because they require the liquidity.
And then there's the rest of us.
Then there is the retail investor, the registered investment advisor, building a retirement portfolio, who buys and holds for 30 years. They prefer the QQQM.
So Invesco successfully captured both ends of the demand spectrum. They built a seawall against fee compression with the QQQM, which allows them to protect the massive margins on the flagship QQQ without losing the retail flows.
They are playing a completely different game than the competitors who only have one lever to pull slashing prices.
Management is playing chess, not checkers.
And the brand equity is another massive barrier to entry. Allison Dukes casually mentioned that they have invested north of $1 billion in marketing the QQQ brand over the decades.
You see the logo at every major sporting event, March Madness, golf, everything.
It is ingrained in the cultural lexicon of investing. Yeah. A competitor cannot instantly replicate $1 billion of cumulative brand awareness with a press release announcing a lower fee.
Which naturally brings us to the bottom line. We have dissected the headline metrics, the structural mechanics of the ETF and SMA platforms, the aggressive balance sheet restructuring, and this brilliant defensive posture on pricing. We have to synthesize this into an actionable verdict for the retail investor listening right now. If you are analyzing IVZ today, what is the core thesis? Hold, fold, or buy?
From a fundamental analysis perspective, the verdict on this quarter is decisively bullish.
Bullish. Okay, lay out the why.
Invesco has demonstrated an exceptional ability to balance their asset mix to navigate macroeconomic uncertainty. They are capturing the massive secular institutional flows through the dominance of the QQQ ecosystem, while simultaneously capturing the high net worth retail demand for tax efficiency through their SMA business.
They are perfectly positioned at the intersection of the two fastest growing segments of wealth management.
But having good products does not automatically translate to a good stock. The definitive bullish signal is the operational ruthlessness we are seeing behind the scenes.
The cost discipline.
Yes, they are extracting massive positive operating leverage from this top-line growth. They are holding expenses flat while revenue soars, and they are deploying that free cash flow with extreme discipline.
Dropping the leverage ratio below 2.00x fundamentally de-risks the equity. But let's talk about the direct shareholder rewards, because the guidance on capital return was highly specific.
Management formally reiterated their commitment to a 60% total payout ratio.
Let's define that for the listeners.
This metric combines the cash paid out in common dividends with the cash deployed for share buybacks, calculated as a percentage of the company's total earnings.
So for every dollar Invesco generates in profit, they are systematically handing 60 cents directly back to the shareholders.
Exactly. And we saw the execution of that policy in Q2. They executed $50 million in share buybacks, retiring roughly 1.9 million shares, and they have maintained their increased quarterly dividend.
So what does this all mean for someone holding or considering the stock?
For a retail investor holding IVZ, this is a highly attractive income and value proposition. You are holding a company that is actively fortifying its balance sheet, expanding its profit margins, and paying you a substantial yield to wait for the broader market to recognize the fundamental improvements in the business model.
We must address the downside risk, however. No equity is bulletproof.
All right.
The primary risk factor here remains the inherent beta of the asset management industry that we touched on earlier.
Regardless of how brilliant their product segmentation is, or how ruthlessly they manage their expenses, their fee revenue remains tethered to the nominal value of global equities.
If the market tanks, they tank.
If a macroeconomic shock triggers a severe, protracted global recession and the S&P 500 contracts by 30%, Invesco's AUM will mechanically drop and their revenues will compress. There is no escaping that reality.
But the entire point of this deleveraging cycle and the tech platform upgrade is to change how the company absorbs that hypothetical 30% drop, right?
Exactly. When they were operating at nearly 3x leverage with bloated expenses, a market crash posed an existential threat to their equity value.
They might not have survived.
Now, with a fortified 37.5% operating margin and a leverage ratio of 1.9x, they have built a shock absorber. Their earnings will still decline in a bear market, but they will not face a liquidity crisis.
They have built a durable fortress.
One that can survive a winter and emerge highly capitalized to buy up distressed assets or further expand market share when the cycle inevitably turns.
That is a phenomenal data-forward breakdown. We have sliced through the jargon and uncovered a highly disciplined management team executing a complex strategic vision with remarkable precision.
It really is a definitive case study in how to optimize a financial institution during a period of market exuberance to prepare for whatever macroeconomic environment comes next.
Before we wrap this up, I want to leave the listener with one final fascinating piece of data from the call to chew on. We spent a lot of time discussing the QQQ as a domestic phenomenon, but management noted a recent massive structural expansion.
The international cross-listing.
Yeah, they recently cross-listed the flagship QQQ ETF on local stock exchanges in both Hong Kong and Tokyo.
And the immediate capital response was staggering. They raised $10 billion in assets in those foreign markets almost instantaneously.
It is a massive validation of their global brand power, but I want you to consider the broader geopolitical and macroeconomic implications of this move. We are watching the financial plumbing being laid down for a single ETF, tracking 100 United States technology companies to become the default standardized savings vehicle, not just for American retirement accounts, but for the entire global middle class.
The structural implications for global capital flows are profound.
Think about the level of financial interconnectedness this creates. You have a teacher in Tokyo, an engineer in Hong Kong, and a nurse in Chicago, all automatically routing a portion of their monthly income into the exact same index of American innovation.
That's incredible to think about.
Invesco isn't just selling a fund. They're building the infrastructure that dictates where the world's wealth will concentrate over the next decade. How does that massive automated global bid affect the valuation of U.S. tech megacaps?
Or global currency dynamics, when the world's middle class demands US dollar-denominated assets.
Exactly. It creates a structural tailwind for U.S. equity dominance that goes far beyond traditional domestic economic indicators.
It's certainly an incredible concept to mull over while you evaluate your own portfolio allocations this week.
It really is. As always, a quick reminder that while we provide the deep dive analysis, you must keep doing your own research. Read the SEC filings and thoroughly understand the mechanics of what you own. That is a wrap for this Talk Tickers Deep Dive. We will see you next time.